I made copies of the AMT, which I probably didn't bring with me. I'll get it when we're looking at the next thing I want you to look at. But with AMT, one of the important things to keep in your head is that just like it says on the first page of the chapter, it was set up so that everybody would pay their share. And what that share is, everybody can have a difference of opinion, all right? Everybody does have that difference of opinion as we were talking about. But what happened then in 2017 with the tax law changes, and I believe I highlighted this too, is they believe that approximately, before the tax cut, they would have had approximately 4 million people that would have had a positive AMT liability when they filed in 2017, raising more than $25 million in revenue. The tax law changes due to the Tax Law Act reduced that greatly, and that with more, they reduced that change. So they expected that based on that, you guys saw it up there, they expected that less than 200,000 were going to file. Yes, so less than 200. So 4 million down to 200,000. Now, a lot of people were breathing a sigh of relief, and I'll show you here in a second what some of those numbers were, like on how it was cut off. But a lot of people believe that AMT was for that definite upper class, but it was approaching people that were making around $200,000. And so some would argue that wasn't necessarily where it was supposed to be. Some would argue, yes, it should. Again, that depends on where you consider middle class to be, upper middle class to be, and wealthy to be. So this big picture that we're looking at today, Bob and Carol are both unmarried, and they've been engaged for 4 months. They have identical compensation, the same gross income, including investment accounts, solely interest income, similar investments in tax-exempt bonds, same interest income, have the same deductions, but yet Carol learned she paid $15,000 more in taxes. So she wants to know why or how did she end up paying $15,000 more in taxes. So what can they look? Why didn't they have the same tax liability? Were both taxes prepared correctly? Should Carol get a new tax accountant? Should she file an amended tax return? Should Bob change what he's doing? So what is going on? So the first thing, AMT is a separate form, but it's prepared at the same time. It's prepared with it. There's a line for what's called AMT tax. All right. Computations begin with what is our taxable income, and then you have something called AMTI, which is ultimate minimum tax income, and that's what your calculations are based on. So this is the computation of AMT, and I printed this out for you guys so that you can have it. And like I said, it's sitting on my desk, so in a second I'm going to have you read something and I'll go grab it. All right, but it's not a formula that you have to have memorized from a standpoint like how do you come up with taxable income and knowing what's for AGI and what's from AGI. But at the same time, when you're looking through and doing a few problems for AMT, it's not bad to have in front of you. We're going to talk about these adjustments and these preferences. There are exemptions. Exemptions are set amounts, just like they're not the exemptions that went away. These are different exemption amounts. All right, there's 2 different tax rates, all right, for income that goes above and income below, and you have to subtract that. And then you could get a 10 of minimum tax before a foreign tax credit, if there is one. Then you do get to subtract out your tax liability already. So whatever you're already paying taxes on gets subtracted out, and then you have your AMT tax liability. All right, so when we're looking at our tax preferences, let's stop for 1 second, and I want you to read. This is on page 12.4. It's the ethics. Who's going to pay AMT? So I'm going to put it up here on the board.
It actually said previously was 5.25 million people.
Okay. I knew I had read it. As you look at AMT and you look at who it affected with the changes, corporate AMT went away, but one of the focuses of the tax law changes in 17 was to help small businesses. And by eliminating corporate AMT, it did help small businesses. All right? So the ethics talks about the helping alleviate individual AMT, and it has. So that reduction from 5.5 or 5.25 million down to 200 has helped, but it did not eliminate it. So why did they not go ahead and eliminate it? I don't know the right answer, but I believe it's because the original purpose was, in fact, still to help make sure that everyone paid their fair share.
So they said when the 4 or 5 million people who were paying, that was raising $25 billion. So that would be on average $5,000 per person.
Right.
Doing it. So I mean, I'm guessing that the 200,000 are the people who are like really.
I would guess the 200,000 are those that are in the extremely high income. Because based on when you go through and look at what we're looking at now, people that are in that, what I would call upper middle class, are not getting the AMT anymore. They're out of that range. So you're looking at the people that are making a lot of money. The 200,000 seems extremely low to me, but I'm not getting those stats. Those stats could also be wrong. I mean, I guess we'll find out. All right, so let's take it back into the slides. All right, so many of the AMT adjustments that we're going to look at when we're trying to figure out what the AMT tax are is related to timing. All right, so timing differences. They basically reverse over time. So an example is positive adjustments will offset by negative adjustments in the future and vice versa. So regular income tax depreciation is generally faster than AMT depreciation. So depreciation that we have out there. Thus, initially the negative adjustment, decreases in depreciation expenses for AMT, will reverse later. So you take a bigger depreciation expense now, you pay less in taxes. Later, it reverses. So they're saying, let's not do that. Adjustments not related to time can create a permanent difference between taxable income and AMT. That is itemized deductions. So we have some changes due to itemized deductions. Then we have something called preferences. All right, this is designed to take back all or part of a tax benefit in certain amounts included in the computation of regular taxable income. So they don't necessarily get everything. All right. In other words, the regular taxable income that is a starting point of AMT is either increased, well, preferences are always increased, effectively by disallowing the benefit.
Could you give an example of a preference?
Yes, we're going to go through and give some examples. We have examples of all of them for you. Well, here's preferences right now. So these are the three that we are not going to go into detail on, all right? But we will. So percentage depletion is an example. Excess intangible drilling costs, and interest on private activity bonds. Now, interest on private activity bonds we will actually go through, and there'll be an example on. The other two, no. I will not do an example on. And then other components, exemption amount. The exemption amount of AMT to arrive at the base, we're going to look at those. And the exemption amount is phased out at 25 cents on the dollar when the AMTI exceeds that base. So we're going to look at how we phase that out. I just realized something. I don't know if I'm going to say it. No, I am. Okay. I am. I'm just not quite there. Okay. I'm like, why haven't I reached something? All right. So here's the exemptions amount, and then we'll look at an example. So the exemption amount based on married, single, head of household, and filing separately. And then we were talking about dollar amounts. Look at the dollar amounts. So if you're single or married filing separate, you're looking at a phase out starting at $510,000. So to me, this is a much better, well, okay, look at the married amount, $1 million. Before these adjustments were made, I was doing taxes for people. Now, first of all, I don't do any taxes or know anybody that husband and wife together make $1 million. So let alone do their taxes. I wouldn't want to do taxes for anybody because I don't get paid to do taxes, and I sure the heck don't want the liability of doing taxes for someone that has $1 million. So, but I did someone's taxes, a friend of mine who has rental property that him and his wife together made $250, and they paid AMT a couple years ago. That's the difference. All right? So that's a big jump. head of household is 510 or single, again, big difference in it. So those are we're looking at the exemptions amounts. So let's look at example 1 and 2 in the book. Okay. All right, so there's the exemption amounts right in front of us. And it says Harry is single. He records AMTI of $680,000 for the year. So that's how much money Harry makes. So right away we already know he's over the limit. His initial exemption is $71,700. He has to reduce it by $42,000 because he has to take how much he made minus where he begins at, all right, and then multiply it by the phase-out rate. So he's roughly $170,000 over the beginning phase-out rate. So he multiplies that by the 25%, and he gets $42,425. And so then he takes his exemption is now $71,770 minus that $42,000. So his exemption has been reduced down to $29,000. So the more money you make, the less your exemption is. All right. If he would have jumped up to this, $79,700, what would have happened?
There'd be no exemption.
He gets no exemption, exactly. So it would have just increased his taxable income. All right, now let's look at a little bit bigger one. All right, Anna is unmarried also. Now she has taxable income of $450,000, so less income. All right. She has some positive adjustments. Again, we'll look at some of those. $70,000, and she has some preferences. Preferences are always added. Adjustments can be negative or positive. Preferences are always added. Of $65,000. So her AMTI now is now up to $585,000. So her income was only $450,000, but then based on adjustments and preferences, she jumped up to $585,000. All right. So now we have to go look at her exemption. It started at the $71,700, but we had to take the $585,000, and remember, I believe it was $510,000. So we take her $585,000 and subtract the $510,300. Take the difference, multiply it by 25%, and we're going to get this $18,675. So we have to, her exemption is reduced to $53,025. So her exemption is a little bit better. So now her base is $531. So her base went down, which is good. But now we also have to look at how do you tax it? Well, there's 2 tax rates, and I showed you that on one of the first slides. Up to a certain amount, you get to tax at a lower percentage. After that, you have to go up and tax at a higher. So I think you can still see it up at the top of this paragraph. All right. 26% applies on the AMT base up to $194,800. So her first $194,000 gets taxed at 6%. After that, the rest of it gets taxed at 28%. If she did have qualified dividends or capital gains, it would be taxed at the lower rate, just like anything else, but she didn't have any, so we didn't have to worry about that. So then we come up with how much TMT, which is $145,000. But she already has to pay $132,000 just out of her normal taxes. So you subtract that. So her additional tax she has to pay is $12,363. So you see how that is? She doesn't have to pay $145,000 at AMT. She gets to subtract out what she already is paying, and then she pays the difference. So her AMT is the additional amount of money.
Why they call that alternative minimum tax? That means people should
That's
pay
the
less.
minimum. That's how much they should have had to have paid, and they didn't. They did not reach the minimum tax in their mind. They should have been paying $145,000, but yet they got to take advantage of additional credits that, my terminology, us layman people didn't get to take advantage of. So they did not pay the minimum tax on their income. So therefore, they have to pay an additional minimum tax. That's how I'm interpreting what they wrote at the beginning, what AMT was meant to be. With the new tax law changes, they've redirected it and tried to up it. So it's hitting the higher level income. And so basically they're saying at that tax level, they should have been paying $145,000 is what the powers that be and the IRS have decided. I mean, and there's no other way to say it except for the fact that that's what FASB, I mean, all tax decisions go through our government. They go through the tax courts. So they have made those decisions that that's what AMT is going to be. And the tax law changes went straight through Congress. So this was decided that the dollar amount would go up and that it would stay in there for individuals.
But the bottom line is just that whichever is higher, your TMT or your regular tax liability.
That's what you need to pay. Yep. So for some reason, and this does happen, AMT is not higher than this, then you don't pay AMT. So there's been times before the change that I would go through and be like, oh, should this person be paying AMT? And you would go through and fill it out, computer-wise, right? Before computers, I'd have to go through and fill it out to see if someone had to pay AMT because they were just close enough that you're like, with the preferences and with adjustments, you didn't know if they'd have to pay it. So you'd have to do the calculation.
So, by the way, that's the second time people file? Or
No, this is the first time you file. This is when you file in April. You should be doing this if you make that income, if you're in the income level that's above that. All right, so let's go. All right, so AMT rates, I just showed this on there, and I did mention that if you have capital gains or qualified income, they would be taxed at the lower tax rates. All right, so tax credits and personal liability. So when you're looking at AMT, personal non-refundable credits are allowed to offset any tax liability. So we had kind of talked about that. So if you have the credits that we're going to talk about next week, one of my complaints with this book is sometimes they talk about these credits, but they put all these credits in Chapter 13. Adoption credit, education credit, savers credit, all those credits, you can use those to offset AMT. So you could still reduce your tax credit. Did I just skip one? Hang on. Nope, okay. So adjustments. Now, this section says 15 slides. If you want to see all 15, you can go to the PowerPoint slides that are in, but I took these out. These are some of the ones, James, that talked about oil rigging and percentage of completion. Don't know how many people are in here. I really would bet a lot of money that the CPA exam is not going to ask you about oil rigging. Right. Okay. So adjustments tend to arise from timing difference. That's what adjustments are. Things that happen differently between the two. They can be positive or negative, all right? Adjustments related to timing will generally reverse in later years. So we're trying to make sure that you're not taking advantage of something now that later would not be the case. MACRs, all right, we talked about that already for depreciation. Recovery periods apply for AMT purposes only. Thus, no adjustment for real property depreciation is needed. So we don't have to do an adjustment there. For real property placed into service after 1986, AMT depreciation is computed using straight line. All right? But recovery period under alternative depreciation systems. Now, I'm just going to take you back for a second. We really didn't do ADS. We talked about it, but we did most of our focus was on MACRs and then a little mid-year and a little fourth quarter, all right, where we had to do where we had to do mid-quarter because they purchased it in the last quarter of the year. So if you use straight line, it's over 40 years. If you use regular MACRs, it's 27.5, 31.5, and 39. So the adjustment could be for that purposes, and then obviously if you're doing depreciation using a recovery of ADS over 40 years, you're stretching it out versus maybe where you've already compacted it. So it's going to decrease your adjustment. MACR's recovery periods for AMT, the depreciation is driven by the difference in the depreciation percentage. All right, now, If you're using 150 down here for regular tax, you don't have to have any adjustments. But where personal property tax was using 200, double declining, adjustment has to be switched down to 150. They're not going to let you take double declining for AMT purposes. All right, it appreciates too fast. For property in which you took the additional first year depreciation, remember when we talked about that? You could take an additional or the bonus depreciation. No depreciation adjustment is required either in the year it's placed or the remaining recovery period. So you do not have to take an adjustment. Now I jumped to 9. This one I talked about earlier. Stock options are a big one. Stock options can create income for AMT purposes, right? And normally this would not be taxed for regular stock tax purposes. And this is the excessive fair market value over the excise price is the adjustment in the taxable in the year in which you exercise them. All right, this is different than, so when we get stock options, nothing shows up on our taxes when we exercise them. When does it show up on our taxes?
When you cash them in.
When you sell them, right? Because when you sell them at a gain or loss, right? That's when they show up in your taxes. For adjustments for AMT, it shows up when you exercise them. Because just a couple things to think about here. The highest level people in companies receive the most stock options. Stock options can be worth a lot of money, correct? So I guess the purpose behind this is, and a lot of stock options are considered part of their regular compensation. So they're trying to make sure that you might be making $1 million a year, but you also have then $4 million a year in stock options that you're giving, but you're not being taxed on those.
There are stock options where they'll say, you can buy this at $100 a share in the future, even though it's actually worth $130 or $150.
Right, exactly, right. So you buy it at $100 now.
Oh, so you do have to buy it right away?
Right, when you exercise them. If you exercise them, if you buy them at 100, you have to show them on AMT as buying them. Okay, because to them, you are now exercise at the fair market value. So if you buy them at 100, the excess over the fair market value is the adjustment in taxable income. All right, at the time that you buy them. So if you buy them at the same price that they're worth, then you have nothing. But if you buy them at 100 when they're going for 130, you have a $30 gain on each tax. And so what they're trying to do is show that you already just made
A lot of money.
a lot of money, okay? That you are not paying tax on, even though you haven't sold it, right? But the normal person that's not making over I'm going to pick $200,000, doesn't get stock options on as a regular part of their salary. Because most people under that salary don't get stock options. We might get bonuses, but what happens when you get a bonus? You get taxed on it, exactly. So that's what some of this is trying to do. If you get something that's part of salary, which stock options are for people in higher, then pay tax on it like it's part of salary. So, all right. Now this one's fun because I already know you guys don't like this topic. Okay, but net operating losses must be recomputed for AMT. All right? So the starting point is computing the alternative tax on the NOL deduction. All right? And it's computed for regular income tax purposes. Regular income tax is modified for the AMT adjustments and preferences. So basically, you're going to go through and do all your preferences and adjustments and then recompute the NOL. So it's not like you're like, what do they mean? You're going to go through all these preferences and adjustments and then figure out what your net operating loss is. It's still a pain in the butt. And then some more easier adjustments. All right, these adjustments are just straight out allowed. You can do these. Adjustments, itemized deductions, these are allowed. Casualty losses, however, we all know casualty losses now have to be in what kind of area?
Itemized deductions.
In a what? Federally declared area, right? Okay. Gambling losses to the extent of winnings, charitable donations, medical, and qualified interest, all right? These ones are not. So for AMT, you are not allowed these itemized deductions. So any state or local income taxes previously deducted. So this has not taken quite as big a hit because now all of us can only do 10,000, but you can't even do 10,000 for AMT. Again, thinking those that are in the higher income have much bigger houses, therefore they are being able to take advantage of taxes that are $45,000, right? Well, now they can't either, right? Everyone's limited on 10. So that's not as big a deal anymore. Gross income may include a refund of state income taxes deducted in prior years, which could result in a negative. Okay. AMT allows for interest expense, includes only qualified housing to the extent that the interest income is included in AMTI. So any interest deducted from regular tax that is not permitted in calculated AMTI is treated as a positive. So you can have qualified housing interest. So that's the same interest that you and I have. Okay?
When you say housing, you're just talking about mortgage?
Yes,
interest?
yep. AMTI does not allow for the standard deduction. All right? So if you take standard deduction, you don't get to do it. Now, that one would floor me. You got people making over $500,000, $1 million married that are taking the standard deduction, I would be surprised. But it does not allow for it. All right, preferences. So you guys had asked about a couple preferences. They tend to arise because of deductions or exclusions that provide substantial regular tax benefits. So things that normally. So unlike adjustments, these are only positive, and they usually reduce benefits received by regular tax computation. So again, we talk about what are these. So the one that we're going to talk about is that interest on private activity bonds, because the other two are pretty not as common. So private activity bonds are not taxable for normal tax purposes. You and I would not have to pay tax on private activity bonds.
Can you explain what a private activity bond is? Or
Vaguely.
An example?
I can't give a great example. Private activity bonds,
We're not talking about school.
no.
municipal-
We're not talking about any of the bonds you would have learned in financial accounting. All right, none of those bonds. These bonds are going to be, I'm trying to give an example, and that might be harder than trying to explain what it is. They're going to be exclusive bonds that are not open to the public. Okay, they're not going to be the bonds that you see municipalities do, the school districts do, the government do. Not the open bonds where you know, they're kind of like on the market in the open bond market. They're going to be bonds that are set aside that are, the reason they're excluded for interest from you and I are they're for special activity groups. So the whole purpose usually has some type of benefit towards it. That is why you and I don't have to pay interest on it. I don't know how you and I would get one. Hang on one second. Let's just do what my kids would tell me to do. All right, so outside of the normal bonds that you and the government would do for issuing, like of the highway and all those wonderful things, these would be tax exempt bonds issued on behalf of the government for the purpose of providing special financing benefits for special qualified projects. The financing is often for projects of a private user, and the government does not usually pledge its credit, but they are tax exempt. So special projects by the government. So that's why they're not your highway bond or your let's build a community college bond. And the government is not putting its backing behind the credit. So that's a little scary, but yet they're tax-free, so that's kind of interesting. So for AMT purposes, you would have to pay, you'd have to include that interest. You'd have to add it to your income. We get to deduct it. They're saying that the more money you have, the more money you have to invest in private activity bonds. Hence the reason we just had to Google it, right? I don't know. But so you have more to do things like that, kind of like the charity. So therefore, you'd have more of the interest. You would have to pay tax on it. Expenses in carrying these bonds are not deductible, but they often offset the income. The interest issued after, but before 2011. Now notice, what are those dates? Not all of you are old enough, but most of you, 2008, 2011, what was going on?
The Great Recession.
Okay, so look what they did. Interest during that time was not a tax preference. They were trying to get people to invest in those special activity bonds. We're now back to the point that they don't care, so now you gotta pay tax on it again. All right? So those bonds were out there as special activity bonds trying to get people to buy them, but now they're like, now you gotta pay a preference back on them again. All right, gain on the sale of certain small business stock is excludable for regular tax purposes, some of ours. All right, if the stock was acquired after 2010, there's certain stock that is excludable for AMT purposes, 100% of it. Some of that stock is C Corps. No, not C Corp, S Corps. All right, some of those smaller companies. There's something when sometimes they have the stock and different companies that are very small can be excluded from gains. It's not S Corp either. But it's not for preferences there. All right, so before I do these slides, I have another problem. So, what do I do with it? That's the question. Here it is. All right. So, I will put it up on the board. Slowly. There it is. So this one should be easier. We're looking for her base. What is Rosita's base? So Bob and Carol both had invested money in private activity bonds, all that were issued in 2010. So a tax preference did not result for either Bob or Carol in that. All right. An AMT credit for timing differences creates an AMT credit, excess of AMT for the differences. So AMT credit could not be carried forward indefinitely to be used. Regular tax liability in the excess of any tentative minimum. So a tax credit cannot reduce the tentative minimum tax credit. So what does it say? An AMT credit is a little different than the other credits that we've had. All right. So an AMT credit can be carried forward to be used to offset regular income tax liabilities. All right. But a regular tax liability in excess of a regular tax liability over a tentative minimum tax liability, that tax credit, that's what the tax credit is. Okay? Court tax, we talked about that, that's gone. So Bob contacts Adam and asks if he underpaid by $15,000. That's what everybody wants to hear, right? Adam looks at the tax and finds the differences relate to the treatment of the interest earned on the tax exempt. Bob and Carol both own the tax exempt bonds, including private activity bonds that generated the differences. Carol's accountant overlooked the interest on the private activity bonds is not a tax preference where the bonds were issued in 2010. So thus the $15,000 AMT that was reported on Carol's 6251, which is the AMT form, was an error on Carol's. So hers was actually a mistake. It wasn't a timing difference. It wasn't a way that they invested on hers. Her accountant actually did make a mistake. But it was a mistake because it happened in that time frame of 2008 to 2011.